The US government just gave silver a title that changes everything for your portfolio: critical mineral. But while the media is quiet, the market is screaming. Hecla Mining just dropped a 30% premium on a new acquisition, and the APMEX supply lines just hit a reset point we haven't seen in years. This isn't just about a price floor at $78, it's about a structural deficit that has been building for 5 years and is finally about to snap. If you don't know the difference between speculative noise and strategic value, your 2026 is about to get very expensive. Let's look at the data. Thursday, February 19th, New York time. Comment your date below so I can see where you're watching from. If you value this work, subscribe and comment George Williams. It really helps. And I mean that, because what we are about to walk through today is not noise. This is not speculation dressed up as analysis. This is real market data, real institutional behavior, and real physical demand telling you something very specific about where silver stands right now and where it is likely headed next. So let's get into it. First, let's talk about what a price floor confirmation actually means, because this term gets thrown around a lot and most people half understand it. A price floor in any market is a level where buyers consistently show up and refuse to let the price fall further. It is not a guarantee. Nothing in markets is a guarantee. But when that floor gets tested, especially after a violent emotional sell-off, and the price holds and then starts climbing back, that is the market telling you that the panic sellers have been absorbed. The weak hands are out, and what's left is a price level that the market genuinely believes represents fair or undervalued territory. Now here is why this particular floor confirmation matters more than most. Cast your mind back to January 29, 2026. Silver hit an all-time high of $121.636 per ounce. That was not a slow grind higher. That was an explosion. A historic move that had the entire financial world paying attention to a metal that mainstream media had largely ignored for years. And then, almost as quickly as it happened, it reversed. Hard. The price crashed back towards $70 in a matter of days. U.S. Treasury Secretary Scott Bessent publicly pointed the finger at Chinese traders, describing the rally as a speculative blow-off, fueled by aggressive positioning that ultimately unwound at brutal speed. Nearly half of silver's value evaporated in what felt like a blink. That kind of crash shakes people. It's supposed to. It shook out the momentum chasers, the leveraged longs, the people who bought silver at $110 because a YouTube channel told them it was going to $200 by the weekend. But here is what you need to understand about that crash. The price stopped falling around $70, and right now silver is trading around $78 per ounce. That recovery from $70 back to $78, that is the floor confirmation analysts have been waiting for. The market tested the low, found buyers, and pushed back. That is meaningful. That is not a coincidence. Now let's talk about Hecla Mining, because this is where things get genuinely interesting and where a lot of retail investors are missing the bigger story. Hecla Mining is not a name that trends on social media. It doesn't have the cultural presence of a Tesla or an Apple. But in the world of silver mining, Hecla is one of the most significant primary silver producers in the United States. They know this metal. They live this metal. They have operations running across some of the most productive silver regions in North America. And when Hecla makes a move, the people who understand this sector pay close attention. So when Hecla Mining announced an acquisition at a 30% premium to market value, that is not a small thing to brush past. That is a massive signal. Think about what it means when a company that operates in the silver mining space, a company with deep knowledge of production costs, reserve values, and long-term price projections, decides to pay 30% above what the market is currently pricing an asset at. They are not doing that because they think silver is going sideways. They are doing that because their internal models, their geologists, their financial teams, all of them are telling them that the current spot price dramatically undervalues what silver assets are actually worth over the next 3 to 5 years. Smart money does not overpay in the short term unless they are extremely confident they are actually underpaying in the long term. That is the logic you need to hold on to here. This kind of premium acquisition is historically one of the clearest bullish signals you can find in any commodities market. It happened in gold before major bull runs. It happened in copper before the green energy boom sent prices surging. And it is happening in silver right now. The institutions and the operators closest to the ground are telling you something with their wallets that their public statements never quite capture directly. You just have to know how to read it. Now let's address APMEX. Because if you've been in the silver stacking community for any length of time, you know exactly what APMEX is. For those who don't, APMEX is one of the largest online precious metals dealers in the United States. When you want to buy a physical silver coin or bar, APMEX is one of the first places millions of Americans go. They are essentially a barometer for retail physical silver demand. So when APMEX ran into a shortage, when they genuinely could not keep certain silver products in stock because demand from everyday buyers was overwhelming their supply chain, that was a loud alarm bell about the gap between paper silver trading on exchanges and the real-world physical market. The shortage signaled something important. It told you that the people who want to hold actual silver in their hands, not a futures contract, not an ETF, but real metal, those people were showing up in numbers that dealers weren't fully prepared for. That kind of demand doesn't appear from nowhere. It reflects fear, it reflects conviction, and it reflects a growing mainstream awareness that silver is not just a speculative trade, but a genuine store of value worth owning physically. Now the shortage is reportedly over. Inventory has been restocked. And you might be wondering whether that's actually bearish, whether it means demand has cooled. Here is the honest answer. It could mean both things simultaneously. Supply coming back online is operationally positive for the market because it removes the friction that can push premiums on physical silver to absurd levels above spot price. But the end of a shortage does not mean demand has disappeared. It means supply caught up. The underlying reasons people were buying physical silver, inflation concerns, geopolitical uncertainty, distrust in financial systems, and long-term conviction in silver's industrial role, none of those have gone away. The more important signal here is that the shortage happened at all. That alone tells you where retail conviction sits. And speaking of the bigger picture, let's talk about the macro environment, because silver does not move in a vacuum. The Federal Reserve is widely expected to hold interest rates steady at its March meeting. That alone is not a huge catalyst, but what matters is what comes after. Markets are currently pricing in 2 rate cuts later in 2026. And before you wonder why that matters for silver, here is the direct connection. Lower interest rates mean lower real yields on safe assets like Treasury bonds. When bonds pay less in real terms, the opportunity cost of holding silver, which pays no yield, goes down. Silver becomes relatively more attractive. This dynamic has played out across every major silver bull market in modern history. Lower real rates are rocket fuel for precious metals, and the trajectory right now is pointing in that direction. Add to that the recent economic data. U.S. retail sales stalled unexpectedly in December. The GDP control group, which strips out the volatile components and gives you a cleaner read on underlying consumer spending, fell 0.1%. These are not catastrophic numbers, but they are soft numbers. They are numbers that confirm the economy is slowing, that the Fed's rate hikes have done their job of cooling demand, and that the next policy move is almost certainly going to be a cut rather than a hike. For silver investors, that is the environment you want to be positioned for before it fully arrives. And then there is something that does not get nearly enough attention in mainstream financial media. The US government has officially designated silver as a critical mineral. Let that land for a moment. The government, not a hedge fund, not an investment bank, not a silver bug on the internet, the actual US government has looked at the supply and demand dynamics for silver and decided that securing access to it is a matter of national strategic interest. Why? Because silver is irreplaceable in solar panels. It is essential in electric vehicles. It is a key component in AI data centers and the broader clean energy infrastructure being built right now that is expected to scale aggressively through 2030 and beyond. The industrial demand story for silver is not a projection anymore. It is policy. It is infrastructure. It is already being built. And here is the problem. Supply cannot keep up. We are now looking at 5 consecutive years of silver supply deficit. In 2025 alone, the deficit was estimated at 63.4 million ounces. That means the world consumed 63.4 million more ounces of silver than it produced. In 2026, that deficit is expected to narrow to around 30.5 million ounces, which sounds better until you realize it is still a deficit. Mines are not being built fast enough. Silver is primarily a byproduct metal, meaning most of it comes from mines targeting copper, lead, and zinc rather than silver itself. You cannot simply flip a switch and produce more of it because the price went up. This structural imbalance between supply and demand is the foundation beneath everything else you're watching in this market. Now let's talk about where the major institutions stand on price, because the range here is extraordinary, and you need to understand what it means. Citigroup has a target of up to $150 per ounce. Bank of America has put out an aggressive call toward $309 per ounce. TD Securities sits at an average of $65.50 with a high scenario of $118. BMO Capital is the conservative voice at $55 per ounce. The spread between the most bearish and most bullish estimates is enormous, and that itself tells you something. It tells you that the smart money does not agree, which means the market has not made up its mind yet, which means the opportunity window for people doing their homework right now is still open. Even the most conservative forecast on that list, $55, implies silver at current levels around $78 is arguably fairly priced or slightly extended in the short term. But the long-term bull case from every institution remains intact. From a technical standpoint, the levels you need to have on your radar are clear. Support sits at $70, at $60, and at the critical long-term zone around $50, which ties directly to the historic breakout level and the peaks from both 1980 and 2011. There is also a secondary bounce zone around $54.50 from the October 2025 high. On the upside, silver is in price discovery territory. There is no prior resistance to reference above $121 because the metal has never been there before. That is both exciting and humbling. It means price action above the old high is impossible to predict with technical precision, and anyone telling you exactly where silver stops next is guessing. What you should realistically expect for 2026 is two-way price action. This is not going to be a straight-line repeat of last year's explosive move. There will be sharp rallies, there will be sharp pullbacks, and the investors who navigate it successfully will be the ones who understand the underlying story rather than reacting emotionally to every daily price move. So what do you watch from here? 3 things. The upcoming U.S. jobs report. A weak number accelerates the case for rate cuts and pushes silver higher. The next inflation print. If it comes in soft, same result. And Fed language. Pay close attention to how Chair Powell frames the economic outlook at the next press conference, because the tone of that language moves precious metals faster than almost any other single catalyst. Silver at $78, with a confirmed price floor, a major miner paying 30% premium for assets, physical dealers restocked after a shortage, critical mineral designation locked in, 5 straight years of supply deficit, and institutional money divided between $55 and $309. This is not a market that has run out of story. This is a market that is setting up for its next chapter. Make sure you understand which side of that story you're on. Stay informed, do your own research, and if this kind of analysis helps you think more clearly about your money, subscribe, drop a comment below with where you're watching from, and share this with one person in your life who needs to hear it. See you in the next one.